They say a change is as good as a holiday. If that's true, could somebody please let Canberra know that I just don't need any more holidays? In the past few weeks, we've seen changes to capital gains tax, property investment, now SMSF borrowings, and trust arrangements are just around the corner. While the details are still evolving, one thing is becoming very, very clear. The tax landscape over the next few years is going to look very different to the one we've become accustomed to. And if you haven't noticed, it's the last week of this financial year. So if you still have some tax planning questions, please give us a call. But for now, I'm already looking ahead. I'm turning my attention to tax planning strategies that will need to be implemented in light of the new changes. Firstly, capital gains tax. Look, the biggest issue here may not even be the tax rate itself. It may be determining what those assets are worth at 30 June 2027, as well as what they're worth now. Many investors and business owners will require reliable evidence of market value for the assets that they own. That could be assets including investment properties, business premises, share portfolios, trust interests, and privately held businesses. Might be easier said than done, right? In the 12 months up until then, plans will need to be made with regards to what assets should and shouldn't be sold as we reach the deadline for the erasure of the 50% CGT discount. Secondly, SMSF strategies are changing. Hot off the press from yesterday, we thought the super fund sector was going to stay unchanged after the budget, but yesterday we saw an agreement with the Greens and the government to end residential property borrowing arrangements in self-managed super funds. Existing arrangements will be grandfathered and loans for commercial properties will still be allowed. However, this changes the future of SMSF investments and strategies going forward. And thirdly, if it's not already enough, the trust taxation still remains an area of uncertainty after announced in the budget, but still no draft legislation to be seen. These proposals are still being debated, and until we have the final form of the law, caution and flexibility are likely to be more valuable than rushing into any restructure early on. For years, tax planning has largely been about managing this year's tax bill. The next phase is going to be about managing structural change. If you're considering selling assets, purchasing property, restructuring a business, succession planning, or making any major investment decisions over the next few years, now is the time to start thinking about those decisions through the lens of the new rules, not the old rules. When major tax changes arrive, there are two groups of people: those who've prepared and those who spend the next few years talking about what they should have done, what they could have done, and would have done if they had have known more. Which group will you be? If you want to know more information about this or any of your other tax planning needs, please give us a call.